Talk Media Limited, where complex ideas are explained clearly. Hi, I'm TaxMax. Let's break down today's tax topic.
Fact: your main home may be exempt from capital gains tax in many common situations. Today we're looking at corporate capital gains. What happens for tax when a company sells something and the value has gone up? We'll cover what counts as a chargeable gain, which assets are covered and which are not, how gains are calculated, how losses work, and why group rules and reliefs can completely change the final tax bill. Individuals talk about capital gains tax. Companies don't pay a separate CGT charge. Instead, a company's chargeable gains are brought into the corporation tax computation. So the tax charged is corporation tax, but the profit being taxed is a capital gain rather than trading profit. That's a simple sentence, but it's a big mindset shift. For companies, chargeable gains sit inside corporation tax. A gain is normally triggered when a company disposes of an asset. Disposal is broader than a normal sale. It can include giving an asset away, transferring it as part of a wider arrangement, or receiving compensation where an asset is lost or destroyed. In many cases, the key date is the contract date, but the important point is that gains are about disposals, not just cash sales. The corporate chargeable gains regime generally applies to most capital assets a company might own, such as land, buildings, shares, and other long-term assets. But there are important carve-outs. One key carve-out is corporate intangibles. Some intangible assets, like certain intellectual property, fall within a separate corporate intangibles regime, where gains and losses are taxed under different rules. So the first step is always identifying what the asset is and which tax regime applies. Once a gain is calculated, it isn't taxed on its own. Net chargeable gains are brought into the company's taxable total profits. Corporation tax is then charged in the normal way on those profits for the relevant accounting period. The gain affects the final tax bill, but the amount of tax depends on the corporation tax rules and rates applying to that period, as at the time. At its simplest, a gain is the disposal value, less allowable disposal costs, less what the company paid to acquire the asset, and less qualifying enhancement expenditure that added value. That gives a chargeable gain or an allowable loss. If an asset is sold to a connected party or gifted, tax rules may require market value to be used instead of actual proceeds, and allowable costs must be directly linked to the acquisition or disposal, not general running costs. Timing matters because gains are taxed in a particular accounting period. For many disposals, the disposal date is when an unconditional contract is entered into. If the contract is genuinely conditional, the date can shift to when the condition is satisfied. That timing determines which accounting period the gain falls into and which tax rules and rates apply. Corporate gains can become more complex than a simple sale price minus cost calculation. Common complications include part disposals, where base cost must be apportioned, assets acquired or disposed of in foreign currency, and situations where capital allowances interact with the gain calculation. Indexation allowance used to increase the base cost of assets for inflation. For companies, indexation was frozen from 1st January 2018. That means it can still apply to older assets, but it no longer increases beyond that date. For many modern assets, indexation won't apply at all. If a company makes an allowable capital loss, that loss can usually be set against chargeable gains. But capital losses generally don't shelter trading profits. Losses can arise in the same period or be carried forward. Once a company or group exceeds certain thresholds, the use of carried forward losses is restricted. Broadly, there is a £5 million deductions allowance, and above that, only 50% of relevant profits or gains can be sheltered. So having losses doesn't always mean paying no tax. Group rules play a major role in corporate gains. Assets can often move within a group on a no-gain, no-loss basis, meaning no immediate tax charge arises, and the receiving company inherits the original base cost. Groups can also transfer gains and losses between companies by election. But group rules can create degrouping charges if a company leaves the group after assets have been moved, effectively clawing back the earlier tax deferral. When companies dispose of shares, special identification and pooling rules apply to determine base cost. That base cost drives the size of the gain. Similar pooling logic can apply to certain crypto assets depending on how they're held. Getting the base cost right is critical. One of the most significant reliefs is the substantial shareholding exemption, or SSE. Where conditions are met, such as minimum shareholding levels, holding periods, and trading conditions, gains on qualifying share disposals can be fully exempt from corporation tax. This is why two similar transactions can have completely different tax outcomes. Rollover relief allows a company to defer a gain where disposal proceeds are reinvested into qualifying replacement assets. The gain isn't eliminated, it's deferred by reducing the base cost of the new asset. This is mainly a cash flow and timing relief. To recap, companies pay corporation tax on net chargeable gains. Gains arise from disposals. Some assets fall outside the regime. Timing matters. Losses can be restricted. Group rules can defer or trigger tax. And major reliefs like SSE and rollover relief can remove or delay the charge entirely. And this brings us back to the fact we opened with. Your main home can often be exempt from capital gains tax for individuals, but companies operate under different rules. For companies, gains sit inside corporation tax, and reliefs like SSE and rollover relief are the tools that can make the tax bill disappear or move to a later date. Why don't tax inspectors play darts? Because even their aim is too precise. This content is for general educational purposes only. It is not tax advice. Tax rules can change, and outcomes depend on individual circumstances. Always check current HMRC guidance or seek professional advice before acting.
Educational content only, not advice. Rules can change. Thanks for watching. Clear explanations, one place, Talk Media.